pay down debt when we've got negative interest rates around the world? Why don't you do something else with it?
I think the balance sheet has to be strong enough to withstand the lower oil prices, and that's the key, and that's the reason we're going to try and work in the lower end of the range of the 1 to 1.5. And I think it's important that our debt cost comes down. Our debt cost is still high, so from a shareholder perspective, I think it's important that we reduce the debt and invest. We still invested 275.
Reprofiling, that terrific word that means that you pay less for longer. What about that?
I think I'd rather have a strong balance sheet and move forward with investment. We're still investing $275 million this year. Our hopper, we have 3 very large assets, very large oil-in-place assets. We're seeing returns which are extremely lucrative. We're paybacks on our Magnus wells are 6 months. The paybacks on the Kraken investments that we're making are 14 months. So we can still pick and choose investments and pay down debt.
Just looking at your hedges, are they too high? You've mentioned the lower oil price being a risk. Is that because you haven't got full cover with the hedges just simply too high on where the oil price could trade from here?
So we have 12.5 million barrels hedged, around $66. I mean, we can't ever hedge too high. So we're very happy with the highest level possible of hedging. I think we've hedged into paying down our debt and continue to pay down our debt. We've reduced our debt from $1.125 billion on the revolver on the credit to about 600 million as we speak today. So I think we manage it with the payments of our debt.
I want to ask you where we're going here from the oil price, because you were one of the first people to recognise some of the geopolitical risks that were not priced into the oil market, and then they quickly came to the fore and the markets had to scramble to keep up. We've seen an enormous amount of action around the key Strait of Hormuz, for instance. What do you make of where we stand, what's priced into markets on the geopolitical side and what's priced in on the supply side? Do you think that the market is looking at a fair price on the boards right now, or are we a little bit out of whack on the pricing?
So I think we're in reasonable shape. I think on the supply side we're in good shape. OPEC 2.0 led by Saudi Arabia has worked very well and continues to work very well. And I think Saudi and OPEC 2.0 have made a commitment to make sure that the market is not oversupplied. On the demand side, you've talked about the weakening economies and central banks and so on. So we have seen weakness on the demand side. This first half of the year, we've seen 0.6 million barrels a day increase, which is one of the lowest over the last 4 years. It's interesting to note that the US dollar strength has affected demand significantly in the emerging markets. So we are almost near highs if you look at India and China. In India, we're about 4,000 to 5,000 rupees per barrel, which is similar to the highs of the oil. And in China, about 500 or 600 yuan per barrel. So I think the higher US dollar and the higher prices in local currencies affected demand. However, you have, as you've mentioned, you've got central banks itching at trying to make sure that we don't have another recession or making sure growth is underpinned going forward.
Amjad, you have been a beneficiary of the ultra-heavy oil tax allowance that the UK government has put on North Sea oil. Are you terrified that Jeremy Corbyn could become the next leader of the UK? What would a Labour government mean for taxation of your assets in the North Sea?
I'm not terrified. But obviously, we want a government, whether it's a Tory or other government, that is very business friendly. And so, I do think that the industry is important for the UK, continues to be important for the industry, for the UK, including the oil industry. And so, I think it's important that we are taxed fairly.
And in terms of your CapEx guidance, I see for 2019 you're looking at for CapEx around $275 million, weighted toward the second half of this year. Would your CapEx plans change if we see a Labour government come into power?
I think right now the commitments for the second half of the year are already in place and would be carried forward. Indeed, some of our commitments for next year would be carried forward. I think we would look at the returns on investments for making CapEx decisions, and once those returns are underpinned by whatever the macro environment is, we'd make those decisions.
All right. Well, thank you very much for joining us this morning, Amjad Bseiso, CEO of EnQuest. Well, the world's biggest investment banks have had their worst start to the year since 2006, and Goldman Sachs CFO says it's understandable. They're concerned about central bank easing. Hear exclusively from Stephen Skur next.
get greedy whenever you want. Subscribe to the American...
At Tesco, we can pop our pasta in your Astra, our Red Leicester in your Fiesta, or our mayo in your Mondeo. All you need to do is try Click and Collect. Just go to tesco.com, order your shopping, then click and collect. With the minimum basket spend now only £25. And if you fancy something a little more exotic, we can even put our pad thai in your Qashqai. Try Click and Collect at tesco.com. Every little helps. Selected larger stores. Booking charge may apply. See online for full terms and conditions.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
Over 9,000 scooters and motorbikes were stolen in London last year. Lock your bike, chain the rear wheel, and cover it to make it harder to steal. Lock, chain, cover. The Met Police.
Did someone say winter sun? It's that time again, and this year at Jet2 Holidays, we're saying Cyprus. On this incredible island, you get it all. A choice of 4- and 5-star hotels, amazing ancient ruins for culture-packed days out, hiking and cycling trails for active adventures, and plenty of blue flag beaches for soaking up that winter sun. Book Cyprus now with just a £60 deposit. Jet2 Holidays. Package holidays you can trust. APRA and ATOL protected, subject to availability and conditions.
Casa Bacardi is back, bringing a party with an unmissable lineup and tasty rum cocktails to London. With Bacardi's new Sound of Rum crew, featuring live sets from One Asen and P Money, MCing from Harry Pinero, and loads more. The perfect recipe for an epic night out. Casa Bacardi at Box Park Croydon on September 14th. For more info and to get your tickets now, head to boxpark.co.uk. Do what moves you. Over 18s only. Drink aware for the facts.
Strings and things. Strings and things. Strings and things. Strings and things. Strings and things and strings, strings, strings and things. Strings, strings, strings and things. Strings, strings, strings and things. Strings and...
Now there's a whole range of strings and things called Strings and Things, including cheese strings, yollies, and new cheese shapes. Find them all in the cheese and yogurt aisle.
Strings and things.
Make sure you're uni-ready with our huge range of practical essentials and home-from-home comforts and get 10% off for a limited time. T's and C's and exclusions apply. Dunelm, the home of home.
The world's biggest investment banks are feeling the heat from a triple threat of factors, according to Industry Analyst Coalition. Sluggish economic growth, persistent low rates and geopolitical tensions have driven revenues down to a 13-year low during the first half of this year. Equity trading desks put the most pressure on performance, with revenues falling 17% year-on-year across all regions.
Oh, it's about time we had a little banking belt, isn't it? So let's do a few more stories about the banks. UBS is set to overhaul its embattled investment bank business after a run of bad quarters. That, according to a number of reports, the lender is set to fuse its equities division with its smaller foreign exchange rates and currencies unit. The restructuring, which could be announced as early as this week, will also include hundreds of job cuts. UBS has declined to comment on these reports. Stefan Engels will depart Commerzbank as CFO and take up the same role at Danske Bank in April 2020. He will take over from Christian Balzer, who will leave his position at the troubled Danish lender, which has faced allegations of money laundering.
Concerns at investment banks over easing central bank policy are, quote, understandable, according to Goldman Sachs CFO Stephen Skur. Annette spoke exclusively with Skur and joins us now with more. Annette, give us the highlights of what Mr. Skur had to say.
Well, actually, one of the highlights was that he is thinking that the recession can actually happen also in the United States. But let me bring you back to the topic of easing central banks and what it does to the banks. Because clearly, like the continental European banks, especially the German banks, are pretty much complaining that a further easing of monetary policy would create bubbles and assets wouldn't bring anything positive because there's not so so much more central bank policy can do. But at the same time, the CFO of Goldman Sachs is saying, listen, it depends on which business model you have as a bank, whether more negative interest rates will actually harm your business model or not. So take a listen of what he said, what actually a potential negative interest rates or more easing could potentially do to Goldman Sachs.
It's less of a concern for us, just given the nature of our business model, meaning the way in which we fund and the floating rate nature of the assets doesn't lead to the kind of concern that other big commercial banks would have. But if you look at major money center banks in the U.S., as you do big money center banks here in Europe, they all have anxiety about the prospect of ever lower rates and the inability to generate assets, sufficient to meet, their cost of capital and their cost of funding. And so it's understandable that that's a big concern. It's a concern shared on both sides of the Atlantic, but mostly by big money center banks in both jurisdictions.
Yeah, clearly in the States you still have quite a leeway to cut rates before you turn into negative territory. But still, do you think the yield curve will invert further, meaning that you could get negative yields also at the longer end in the American yield curve?
Well, we've seen the inversion, of the 10-year now at its widest since 2006, 2007. And I think it reflects a sentiment in the market, perhaps more than the actual data does. But the bond market is reflecting a sentiment that there is anxiety about the prospect of a recession. Though, again, in the U.S., less evident in the data, perhaps more evident in a variety of different markets like Germany here in Europe. But it's possible. But I think the bond market is signaling something as it relates to the sentiment, and I suspect many central banks around the world, not least of which is the Fed, the ECB, are acting on that sentiment, as you might expect them to, so as to forestall, what may be on the come.
So what is interesting, though, is that he also was saying in another part of that interview, it's not only the bond market actually signaling a recession. It's also, if you look at the equity markets, that the only shares which are actually performing very well are the defensive stocks and the cyclical ones, which are also, as we all know, kind of reacting proactively to a potential downturn, are also not doing well. So essentially, the markets do think that a recession is probably inevitable, and that's the scenario under which Goldman Sachs apparently also now is doing business. Another part of that interview I bring you a little later. He'll talk about Brexit and what their plans are for a potential hard Brexit. Goldman Sachs has already moved quite a substantial amount of people into Frankfurt, and most likely, if we are going to get a foreseeable scenario with Brexit, then there could be more moves to come into Frankfurt. That Handelsblatt Banking Conference, to sum it up briefly, was very much about the threats to the business model of the traditional banks. These come clearly from digitalization. We are talking about that since years, but now it becomes more and more clear that those banks who haven't addressed the issues or the challenges to digitalize more are in a very bad spot currently. And of course, geopolitical risks do play a major role also in the business outlook for banks, especially the speech from Christian Sewing, the CEO of Deutsche Bank, was concentrating on a plethora of geopolitical risks who are actually endangering their business outlook. At the same time, we have all these strategy problems with those lenders. We're waiting for a strategy update from Commerzbank, and also the implementation issue with Deutsche Bank's new strategy are a key concern to investors. Back to you.
Thank you very much indeed, Annette, for that. Let's have a quick look at where we are on the Treasury story then. As you can see, we're 1.47 or thereabouts on the 2-year note. The 30-year, just a smidge under 2% at this point. Alan Greenspan thinks we may see negative rates in the United States. Speaking with CNBC, the former Fed chairman said it won't be long before negative rates reach the U.S.
You can see pretty much throughout the world, it's just a matter of time before it hits more in the United States. And I think the issue here is watch the 30-year U.S. Treasury yield. that's going to tell you what's happening.
Well, if Alan Greenspan is right, Peter, then at 1.49, the 2-year is a terrific bargain, but not as good a bargain as the 30-year at around 2%. Fill your boots if we're going negative rates, right?
How much more money are the Fed going to print? How much more QE will they do? 22 trillion of digital money created in the last 7 years, all of which has bought the bond market. So ask Japan, who the Bank of Japan owns nearly 50% of their own bond market. Let's get this right, a central bank owns 50% of its own bonds. What's to stop the Americans doing the same and driving yields lower? Back to my earlier point, the only way to keep the party rolling with this amount of debt is to keep the cost of borrowing low. The best way of doing it is to monetize it, i.e. buy the bond market. So that comment, I don't think it's a recession comment. I think it's a there's lots of people buying it comment, specifically the central banks, which look like they will restart.
What's the argument for not buying bonds at this point, for buying cash instead of bonds?
Because you're going to lose a lot of money when it goes the other way. I mean, the convexity is massive, especially on a 30-year. It doesn't take very much to lose a lot quickly. What is it, that Austrian 100-year bond they issued 2 years ago? It was 100, it's now 198. That's a guaranteed in-your-bank loss anytime you care to pick. It's fine, so why not lose your shirt completely? I don't understand why you buy a bond at negative. Why? Why would you buy the bond that's... You think the German government's a better bet than either spending it, which personally I would do, or going and buying a gold bar, which is the second choice, or just holding it in cash? Why would you buy a bond that's got a negative... What is the sense?
So,
apart from diversification, what is the point? I mean, genuinely, what is the point in buying it?
which pushes you into other assets. And if you consider the prospect of
cash.
a negative bond in the States, though, where does that leave the US banks, which have typically a better profit margin than European ones? Do you naturally say, well, it's going to be a disaster for those US counterparts? Or is it a positive? Because we've seen that the thirst for corporate debt at this point, if there are negative yields in the States, would a bunch of corporates go out there and keep on tapping the market? How do you weigh up the swings and balances for those US banks?
So two things in there. Financial share price in the US, financial shares already tell you that they don't agree with the scenario, that it's they agree with you that it's really bad for them because it's been a crap, quite frankly. And then number two, just looking at that whole scenario of what does it mean for so the best risk pass off has been this bull market is really good for equities. Oh dear, because the assumption is the equity risk premium will come down because bonds are so supportive of other assets. Except it isn't happening, is it? The equity risk premium isn't coming down. This is the Japanese effect, the paradox of thrift. Actually, what is happening, you tell a German that their Bund is minus 60 basis points, they save more money. Welcome to the Japan problem. That's exactly where we are now. And there's no way the equity risk premium is coming down on the back of that. So it's not a positive statement about the share prices of financial shares, and it's certainly not a positive statement about the earnings from American banks. And the financial share price in the last few months, well, actually the last 12 months has told you that. They're not leading the market, are they? Oh, another thing about why you can be miserable if you want to be. Where's the financial share price compared to the rest of the market? It's basically negative. So that's not good either. Sorry, it's still being led again by bond proxies and growth stocks. Disruptive growth stocks are all the money flow is, and bond proxies because people have worked out that maybe the world's not quite as good as they thought it was. So the behaviour is logical.
Now, Peter, in terms of the behavior of market participants, we spoke to Robert Shiller earlier this week on Street Science, who's just written a book, Narrative Economics. He, of course, the Nobel Prize-winning economist for his work on irrational exuberance and animal spirits. And his point is effectively now that a contagious story changes how people behave, and it's going to take a change in the narrative to get investors to stop following growth stocks higher, stop following defensives higher, and change the way they think about markets overall. What do you think could be the catalyst to change the narrative at this stage?
So the only thing I can imagine would be the last thing left is a 100 basis point cut by the Fed, and then it's going to be off to the Congress for some big infrastructure spending. And what's quite funny is, and I think people miss this, everyone thinks, oh dear, Donald Trump will do this big spend. Well, as far as I was aware, the Democrats support that. So why don't we just go on this big infrastructure frenzy, see the UK for reference. We've just borrowed 4% more in the next 12 months with an economy that's got a 90% debt to GDP ratio. And do you think Donald Trump's going to stop? Nope. So the next bit is infrastructure spending. So we're going to take the full circle and then go for the whole fiscal John Maynard Keynes dig the whole thing, which I suspect is next because there is nothing else left. And, oh, by the way, what did the Japanese do? Oh, I remember now. They cut interest rates to nothing and did loads of fiscal spending. Well, that's where we're going next. because there is nothing else. What else is there? Animal spirits are not coming. There is lots of animal spirits giving money to private equity people who take 2% out of it and stay in cash because they look at the multiples they're being asked to pay for lots of the things they want to buy and they won't buy them. So you're in this wonderful cycle of where's the profitability, at the backdrop being over 12 months profits are falling pretty much everywhere globally.
Let me just throw this out. What about the prospect, as we have a tech-focused guest coming up in the next block of the programme, what about that it's different this time because technology is reshaping the cycle and we're going to have a new economy based on new technology?
I get very bored with the 99 brigade who say this is 99 for the fangs. It's not. Is Google on 90 times? Oh, Cisco was on 60 times earnings. Dell was on 50 times earnings. Dell used to grow at 40% on 15 times. 5 years later was on 50 times growing at 15%. That's not the fangs. They're fine. So the fangs are fine, but they got expensive 12 months ago. That's the problem, but they're not the 99 stocks.
Thank you for setting us up for the start of trade this morning. We'll be right back with all the opening numbers for European markets.
Right now on CNBC Make It, this self-employed millennial isn't afraid.
At Romans, you can rent your next home from just £36, plus your first month's rent. No deposit.
No problem.
Romans, your trusted local property experts at romans.co.uk. Conditions and monthly fee apply.
At Tesco, we can pop our pasta in your Astra, our red Leicester in your Fiesta, or our mayo in your Mondeo. All you need to do is try click and collect. Just go to tesco.com, order your shopping, then click and collect. With the minimum basket spend now only £25. And if you fancy something a little more exotic, we can even put our pad thai in your Qashqai. Try click and collect at tesco.com. Every little helps. Selected larger stores. Booking charge may apply. See online for full terms and conditions.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
Over 9,000 scooters and motorbikes were stolen in London last year. Lock your bike, chain the rear wheel, and cover it to make it harder to steal. Lock, chain, cover. The Met Police.
Did someone say winter sun? It's that time again, and this year at Jet2 Holidays, we're saying Cyprus. On this incredible island, you get it all. A choice of 4- and 5-star hotels, amazing ancient ruins for culture-packed days out, hiking and cycling trails for active adventures, and plenty of blue flag beaches for soaking up that winter sun. Book Cyprus now with just a £60 deposit. Jet2 Holidays. Package holidays you can trust. Apps are not all protected, subject to availability and conditions.
Casa Bacardi is back, bringing a party with an unmissable lineup and tasty rum cocktails to London. With Bacardi's new Sound of Rum crew, featuring live sets from One Asen and P Money, MCing from Harry Pinero, and loads more. The perfect recipe for an epic night out. Casa Bacardi at Box Park Croydon on September 14th. For more info and to get your tickets now, head to boxpark.co.uk. Do what moves you. Over 18s only. Drink aware for the facts.
I didn't choose you, you chose me. When you broke from the crowd and pawed at my knee, soon you'll be feeling right at home. You'll be a bit unsure, but you're free to roam. What's good to chew? What's nice to nibble? Wet food, dry food, tin food, kibble? You might sometimes be cheeky, not always wise, but I know I found love in those puppy dog eyes. Join the free VIP Puppy Club from Pets at Home for advice and exclusive offers, including 10% off your first shop in store. Visit petsathome.com/puppy club or join in store. T's and C's apply.
Stock markets in Europe are open for action, and the early market moves have been positive as investors digest the latest news around trade wars. And would you believe investors again responding to optimism that there will be fresh trade talks at a high level in October, early October? Originally, all we had was a conversation later this month, in the next couple of weeks, something a little bit vague, but investors served up a little bit more detail, and that's been positive for the Asian markets, for US futures, and now right behind me, European markets as we begin a brand new trading session. On top of that, though, don't forget investors have been climbing a wall of worry on a series of different factors from Hong Kong to Brexit news, and the events on both of those factors also moving in a positive direction with the withdrawal of the extradition bill in Hong Kong and chances of a no-deal Brexit at this stage slightly improving for market-friendly news participants. And what we've got is the overall picture positive, 0.5% north on the benchmark here in Europe. Let's just dive into this green and see how broad-based it is by sectors. Early suggestions that it might be fairly strong technology right up in front. The bottom of the chart, so basic resources, about 1/3% higher. So every sector in positive territory, but a bit of a difference between the gainers and the bit underperformers on this chip. 1/3% versus 1% on industrials. So a bit of a gap there, as you can see. In terms of other stocks moving, real estate up about 1/3, telcos, more defensive stocks at the bottom end of these charts this morning as investors are just parking their cash in a little bit more risk. Autos, 0.6 plus, financials trading stronger. The three top performers, oil and gas, 0.8 north, technology, industrials now right in front. And you can see this is very much a trade-focused basket. When you've had negative trade news, this has been one part of the market that's been hit. Now as we have better news flow to digest, very much picking up some steam on the back of that news. Let's get into what this means for the individual markets. The FTSE 100 trades high by almost 0.2, 7324. We've reclaimed quite a bit of territory on the UK market of late, all in the context of a rising pound. So that is quite a headwind to look through, but risk on has swept right across markets. And you can see even by the percentage level that the UK market is underperforming the rest of Europe. So in the green, but not quite to the extent that we've got on the DAX. The German market this morning trading higher. The French market up 0.75%, and the Italian stock market trades firmer, just outclassed today by Spanish stocks up by 0.7. Well, Chinese officials have agreed to hold high-level trade talks with US counterparts next month, according to China's Commerce Ministry. Beijing says a meeting has been scheduled for early October following a phone conversation between Vice Premier Liu He, Treasury Secretary Steven Mnuchin, and US Trade Representative Robert Lighthizer. A US trade spokesperson confirmed to CNBC that a phone call between both sides did take place, but did not confirm next month's meeting. A quick look at some of the big sectors. Autos, as I mentioned, one of the better performers of this market. If we can push on, take a look at how some of the big German autos are playing out this morning. And don't forget, there's been separate concerns about whether there could be a trade threat still brewing for some of these big names, but close to 2% higher for Daimler, one of the big ones. Volkswagen about 1.7%, and of the French names, PSA, Peugeot, Citroën, 1.4+%. So very strong trade there. Chip makers, the big technology stocks you can see were very much out in front by an overall basket. And here is how it breaks down at an individual level. AMS, the top one, 4+% in the green. Luxury. I'm curious to see how this is playing out at the start, because don't forget yesterday we saw a bit in the markets for luxury. And that was as we saw some progression, that story around the Hong Kong protests and the extradition bill. So far this morning, a bit more green, so topping up Burberry in particular, 1.4%. Richemont, the maker of timepieces and jewellery, 1.6% higher. So we are seeing an improvement in many of these names. So let's just talk a little bit about where we stand on risk. And I'm pleased to say joining us from the United States this morning is Greg Williamson. He's head of strategy at Pluribus Labs. Greg, we've seen this script before. We've got markets that have been very nervous. They've served up fresh news. Trade talks are happening yet again after 1 year where we've had stop-start negotiations. What do we do with the news?
The news is going to change every day. As an investor, we can trade the news, or we can look at the things that are driving the long-term global economy and invest in those as opposed to try to arbitrage short-term opportunities that might exist.
So driving the long-term picture for the global economy, well, let's get into that, because the inverted yield curve is signaling that we are heading to a fairly bearish phase, that we've got a slowdown about to transpire. Do you put any faith in that, given you're such a long-term market practitioner and you crunch all of these numbers?
For the life of the economy, we have gone through booms and busts, or recessions and growth periods, and this is nothing new. What may be driving the current recessionary fears is certainly different than has occurred in the past. But should one occur, we will weather it as we've always done. The real question is, what will the impact be on corporations in terms of their activities going forward? Will they still invest? Will they take advantage of the opportunities that exist driven by technological change, innovation, and the things that will be driving the global economy over the next 20 years. And historically, yes, corporations have always responded well, and individuals have responded well to those opportunities.
In terms of the negative impact of a negative rate, so one of the key areas that I see you've highlighted in your research is the impact on pension benefit economics. So how concerned should investors be about the impact of negative rates for pension funds and the pension liabilities?
Yes, if you're an institutional investor and you have a liability whose value is driven by interest rates, you have to be very concerned. Of course, a pension liability is a discounted promised future cash flow. As the rates decline, the liability increases. And the ability of an organization then to invest to meet that liability increasing while rates are declining has always been a difficult problem. We saw that in 2008, where you had the perfect storm of declining rates and declining equity prices. It's also impactful in another way for pensions, though, and that is, as people retire, they do have the ability to take a lump sum as opposed to an annuity, particularly in the United States. That lump sum is also calculated based on market interest rates. And if you get low to negative market interest rates, those lump sum values increase dramatically, increasing the liquidity needs from a pension plan, but also turning personnel over at a higher rate, because they're looking at the potential payout, which is increasing due to the lower interest rates, and companies will be losing experienced people because they can cash out at higher rates. And those are significant for people who have been working for their careers. That might be $500,000 in additional payout.
The pricing of paper at the moment raises another interesting conundrum for you, even as a long-term investor. And I think we all know that long-term return depends on the price you pay. At the moment, the price that you pay for anything seems to be elevated given where we are in this cycle. Are you adding anything to the portfolio at the moment from public markets based on your longer-term trend view?
Well, our view is that public markets will be priced expensively and cheaply at different points in time, but over the long term, and this is 10 to 20 years, the things that drive the global economy must be invested in. There will be times when valuations are high, and you want to mitigate the impact of those higher valuations through diversification of strategies and companies that you utilize in your portfolio, through risk-controlled portfolio construction techniques, to eliminating the high momentum, the high volatility, the high price sensitivity stocks from the portfolio, and building your portfolio appropriately.
Sure. I mean, that only makes common sense, but in terms of what you're actually doing at the moment, could you share with us how you are managing your way around some of the price issues then at the moment, even as you perhaps need to add some of this key technology to the portfolio?
So there are several different ways that you can mitigate the impact of high prices. One is just not to buy things at higher prices, valuation models.
And is that what you're doing at the moment?
So we don't use a traditional valuation model. All of our investments are based on what we're being told by unstructured or textual data, what's being written about, what's being spoken about, what's being viewed. And we can and have developed models that look at the text associated with earnings announcements, for example. That text gives you a valuation metric that can be used to help you build portfolios. But you also look at factor exposures, you look at the potential for the company that you're investing in with regard to that long-term exposure that you want to get, and you build your portfolios accordingly.
So let me ask you then, if you were to measure the hit rate of words associated with new technology at the moment over the last 18 months, you would probably think that you should just buy cryptocurrency and blockchain-related stories, because in terms of that analysis, that must have had the biggest volume of hits on your modeling software. But that's not what I assume you're doing. You're not just translating that and saying, hey, we need to find companies that have exposure in the cryptocurrency world.
Well, certainly the first thing you do is look at all of the textual data that's published every day and determine what those trends are that are driving the global economy. You're looking at daily, but the trends you're looking at are those that will be important to the economy 5 to 10 years from now. So it's not just the topic du jour. Having said that, things like blockchain or digital transactions and cryptocurrency could be very large, important economic drivers going forward. There are over 4 million topics or concepts that we're processing every day, but that turns into 25 to 50 investment themes that we'll invest in over the longer term. Once we determine those themes, we then use the data again to determine the sensitivity of every global equity to each of those strategic themes and to the ESG drivers and also to risk factors. With that combination of information, we're able to build portfolios that reflect those long-term economic drivers, not just the short-term fads that tend to be impacting the market.
And one of the key themes we've been discussing and the whole investment community has been discussing is this yield curve inversion. And if you look at Google searches, the number of times that has come up, it's skyrocketed in the wake of the actual inversion we've seen. So how do you factor that in? And clearly that's something that would affect the 5-year investment horizon, and it's something that is coming up more and more as it gathers so much media and investor attention.
We think the question is, would an inversion or a short-term impact change the nature of the strategic trends that will impact the global economy going forward? And in most cases, we don't see that it does. Would a recessionary fear impact the marketplace? Of course it would, but would it impact the things that ultimately drive the global economy over the long term? Much less so. So it's less of an important issue for us, but it's certainly an important issue for shorter term traders and arbitrageurs.
Craig, so those longer term strategic themes, could you share just a few of the ideas?
Things like, nothing that should be surprising to anyone. The themes that we look at are ones that we think are enduring, longer term, have large economic impacts. And if we sat around a table, we would come up with a number of them. Things like agricultural production, the blockchain or digital technologies, water conservation, e-commerce, robotics, health and safety, aging population. I think any people would recognize that those are things that will drive the economy. Our differentiating capability is that we're able to look at each of those trends in a very broad perspective. So it's not just an industry or sector play. We're looking across industries and sectors. We're looking at the companies that have a direct relationship to those trends, but those that also have an indirect relationship. For example, in autonomous vehicles, I think a number of people would say that Tesla is very strongly related to the autonomous vehicle sector, and it is. And the suppliers of Tesla are very strongly related to Tesla and thus the autonomous vehicle sector. But what about the industries that are going to be impacted by the development of autonomous vehicles? Autonomous vehicles don't talk to each other. They talk to a central database. They do that via cellular transmission. Tower companies are a very important part of that portfolio going forward and are developing rapidly. So investment in tower companies is an indirect but related play to an autonomous vehicle portfolio. We'll see that in terms of the impact in terms of housing developments, in terms of infrastructure developments. All of these will be related. So when we look at a trend like that, it's not a disruption play. It's not a single stock play. It's a very broad analysis and investment in those things that drive those particular strategic trends.
All right, well, plenty of food for thought. We'll pick up the discussion just after this break. Greg, you'll stay with us. Shifting gears, let's take a look at one of the corporate stories in focus this morning. Equinor shares are trading higher after the company launched a $5 billion share buyback program. The Norwegian oil giant also announced that operations at a key North Sea oil field will begin in October, 1 month ahead of schedule.
Goldman Sachs CFO says the bank will move more employees to Frankfurt in the event of a hard Brexit. We're going to hear exclusively from Stephen Skerr when we come back. Stay tuned.
Trading is a lot like life. Trading has drama, energy.
More than being fast.
I can find and fund my car, from a Mini to a Jaguar.
Feel good car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel good car buying all in one place.
Shouldn't be a carry on, choose findandfundmycar.com.
At Tesco, we can pop our pasta in your Astra, our red Leicester in your Fiesta, or our mayo in your Mondeo. All you need to do is try click and collect. Just go to tesco.com, order your shopping, then click and collect. With the minimum basket spend now only £25. And if you fancy something a little more exotic, we can even put our pad thai in your Qashqai. Try click and collect at tesco.com. Every little helps. Selected larger stores. Booking charge may apply. See online for full terms and conditions.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
Over 9,000 scooters and motorbikes were stolen in London last year. Lock your bike, chain the rear wheel, and cover it to make it harder to steal. Lock, chain, cover. The Met Police.
Did someone say winter sun? It's that time again, and this year at Jet2 Holidays, we're saying Cyprus. On this incredible island, you get it all. A choice of 4- and 5-star hotels, amazing ancient ruins for culture-packed days out, hiking and cycling trails for active adventures, and plenty of blue flag beaches for soaking up that winter sun. Book Cyprus now with just a £60 deposit. Jet2 Holidays. Package holidays you can trust. APRA net or protected, subject to availability and conditions.
Casa Bacardi is back, bringing a party with an unmissable lineup and tasty rum cocktails to London. With Bacardi's new Sound of Rum crew, featuring live sets from One Asen and P Money, MCing from Harry Pinero, and loads more. The perfect recipe for an epic night out. Casa Bacardi at Box Park Croydon on September 14th. For more info and to get your tickets now, head to boxpark.co.uk. Do what moves you. Over 18s only. Drink aware for the facts.
You're watching Squawk on the European Market Open. And just a quick check of markets, as you can see, still in the green, fairly positive across the board, about 0.6 on the DAX of the core markets, but we have tilted into negative territory on the FTSE, down by 10. So not holding on despite all this risk sentiment about whether there could be some trade resolution with fresh talks in October between the US and China. Let's take you to one stock, CYBG. The stock is down fairly mighty 20%. It will set aside up to £450 million for payment protection insurance provisions. All this is much higher than expected. A volume of inquiries and complaints are coming through the system. Now, the FCA set an August 29 deadline for people who believe they had been missold the insurance. And UBS, which is set to overhaul its embattled investment bank business after a run of bad quarters. According to a number of reports, the lender will fuse its equities division with its smaller foreign exchange rates and currencies unit. The restructuring, which could be announced as early as this week, will also include hundreds of job cuts. UBS has declined to comment on the reports, the stock trading higher by 1.3%. Stefan Engels will depart Commerzbank as CFO and take up the same role at Danske Bank in April 2020. He will take over from Christian Balzer, who will leave his position at the troubled Danish lender that has faced allegations of money laundering. It does trigger an interesting conversation, though, as we've seen Danske trade down more than 30% so far year to date, off of about 9% on Commerzbank. Which one would you rather be positioned in, a recovery play or one that may have some sort of risk premium attached to it on consolidation talk? But just putting that out there for you to ponder. Elsewhere, the world's biggest investment banks are feeling the heat from a triple threat of factors, according to Industry Analyst Coalition. Sluggish economic growth, persistent low rates and geopolitical tensions have driven revenues down to a 13-year low during the first half of this year. Goldman Sachs is prepared for a hard Brexit, according to the CFO, Stephen Skerr. Now, Annetta is at the Handelsblatt Banking Summit in Frankfurt and joins us with more. Annetta.
Well, thank you so much, Karen. Yes, it was an interesting one yesterday because everybody was more or less complaining about interest rates going south. And this is especially a problem for the traditional, like, commercial banks or those banks who have a commercial footprint. At the same time, the likes of Goldman Sachs, they don't seem to have too many problems when it comes to lower interest rates. But they also look at the UK and clearly what's going to happen with Brexit, very, sort of interested, and also they do have an actionable plan. I asked the CFO of Goldman Sachs yesterday in our exclusive interview what they are planning on doing and what their dominant assumption is how the whole thing will pan out, because given the time frame, there needs to be a plan. So take a listen of what he said.
We've long been in the planning stage of, the worst of outcomes, the hardest of hard landings.
And so what happens over the next couple of days, obviously difficult to forecast, but in an outcome which yields a hard Brexit, Goldman Sachs has been preparing for quite a while. And so we have moved a number of people into Frankfurt. We will move more should the result be that way. And so we've been preparing for that outcome for quite a while. For us, it's not a new risk. It's a bit of a seasoned risk, and it takes a long time to plan for that eventuality. And we concluded that might well be the path some time ago and have been comporting ourselves that way.
So essentially, Goldman Sachs had opted for the UK to roll out its retail platform Marcus, but they're also thinking of introducing it here in Germany, because Germany clearly is a very interesting market. There are many deposits, high saving rates, but he didn't want to clarify when they are planning to establish Marcus here as well in Germany. But one thing is clear, Goldman Sachs is preparing to have a big presence here. They have built a tower here in the city center of Frankfurt. They're planning on moving many stuff over in that tower. So there is a shift from the UK into Frankfurt, but clearly the big footprint will remain in the UK despite Brexit, I guess. Having said that, to broaden that picture, it's not only Brexit, which is on a geopolitical risk for many of those lenders. Of course, the trade war, tensions in Iran, what's happening in Hong Kong, there are a variety, a plethora of topics which is weighing on sentiment when it comes to the banking outlook. Back to you with that.
Terrific. Thank you very much indeed for that. Greg Williamson is with us, Head of Strategy at Pluribus Labs. Greg, let's weigh in on this question of US growth, because I think it's one area where there may be some division around the table here. You put in your notes here, growth is reasonably strong with corporate profits increasing, unemployment rates low, and consumer spending steady. There are some who've looked at the ISM data that we had on manufacturing and the level of reported profits for the quarter, beginning to scratch their head about what strength there actually is in corporate profitability.
Yeah, that's an excellent question. So there's the current reported corporate profitability, there's the future expected profitability, and then there are other measures of profitability like the NIPA profit accounts, which take out a number of the accounting transactions and issues associated with profit. If we look at the current profitability, it remains strong, but it is declining slightly. If we look at the future expected profitability, there's still strong growth aspects associated with the potential future numbers. If we look at the NIFA profits, yes, they have fallen because you're taking out the accounting charges and other things. I think the real question is, of course, what are the opportunities going forward? There are a lot of uncertainties in the marketplace with regard to trade, with regard to Brexit, with regard to China activities. Uncertainty breeds contempt. And with contempt, there will be a pullback in investment at the corporate level. Now, is that pullback in investment in human capital? Is it in physical capital, or is it in intellectual property? We're seeing more of a human capital steadiness because there's a need for human capital. We're seeing less of an infrastructure investment, but we're seeing a tremendous investment in intellectual property. The question will be in the future, will that intellectual property investment generate higher productivity gains that will work through to higher future corporate profits? And the expectation is that yes, it will.
I want to ask you about what tanks the economy, what tanks the market, because at this point you've got a barbell approach where some are risk on, some are fully into safety. What's the catalyst? What's that thing that the market should be concerned about?
The market should be concerned about everything, as it always is.
But what actually triggers that?
And from a market perspective, the higher the wall of worry, the higher the equity market tends to go. We know that from trading perspectives over the long term. But in terms of tanking the market, economic difficulties or recessionary fears don't normally tank a market. It just causes the market to go down. And we haven't seen a market go down significantly in a number of different years. Tanking the market is typically caused by an event, a geopolitical event, a black swan, something we don't recognize. And around the world right now, there are the potential for all of those. Yes, a China-Hong Kong hot conflict would be something that's not expected and would definitely cause a reaction and a flight to safety around the globe. Some of the things that perhaps aren't being viewed as strongly or with as much focus would be the debt crisis in Argentina and leading to a potential emerging markets contagion that we have seen in the past, which has caused problems around the globe. Having said that, we do have a much more coordinated central banking activity, which central banking actions and activity, which have put forth a plan and have a pronouncement and an objective to make sure that those types of contagions don't occur again the way that they have in the past. So whether we see something that really tanks the markets, given that we have record low unemployment in most of the developed economies and strong growth, it's really a question to see where that tanking activity is going to come from.
Greg, nice to see you this morning.
Thank you very much.
Thanks very much for coming in. Greg Williamson, Head of Strategy at Pluribus Labs. Anti-democratic and unconstitutional, but is that Boris or Parliament? We will get Willem to unpick that for us when we come back. We will be live from Westminster for the latest on Brexit.
The CNBC app has new features just for you, with real-time market data.
I can find and fund my car, from a Mini to a Jaguar.
Feel good car buying from findandfundmycar.com is the place where you can find quality used cars from trusted dealers rated by you, and where you can fund your car with finance to fit your budget. It's feel good car buying, all in one place.
Shouldn't be a carry on, choose findandfundmycar.com.
At Tesco, we can pop our pasta in your Astra, our red Leicester in your Fiesta, or our mayo in your Mondeo. All you need to do is try click and collect. Just go to tesco.com, order your shopping, then click and collect. With the minimum basket spend now only £25. And if you fancy something a little more exotic, we can even put our pad thai in your Qashqai. Try click and collect at tesco.com. Every little helps. Selected larger stores. Booking charge may apply. See online for full terms and conditions.
This one shouldn't take long. Of course, if it had a cover, I might not be bothered. Can't see what's under there. And then they'd have chained the back wheel. It would have taken me much longer, especially if the chain's off the ground. Makes it harder to cut. This one doesn't even have a lock on the front. So, in the time I've been talking to you, I've nicked it.
Over 9,000 scooters and motorbikes were stolen in London last year. Lock your bike, chain the rear wheel, and cover it to make it harder to steal. Lock, chain, cover. The Met Police.
Did someone say winter sun? It's that time again. And this year at Jet2 Holidays, we're saying Cyprus. On this incredible island, you get it all. A choice of 4- and 5-star hotels, amazing ancient ruins for culture-packed days out, hiking and cycling trails for active adventures, and plenty of blue flag beaches for soaking up that winter sun. Book Cyprus now with just a £60 deposit. Jet2 Holidays. Package holidays you can trust. APRA and ATOL protected, subject to availability and conditions.
Casa Bacardi is back, bringing a party with an unmissable lineup and tasty rum cocktails to London. With Bacardi's new Sound of Rum crew, featuring live sets from One Asen and P Money, MCing from Harry Pinero, and loads more. The perfect recipe for an epic night out. Casa Bacardi at Box Park Croydon on September 14th. For more info and to get your tickets now, head to boxpark.co.uk. Do what moves you. Over 18s only. Drink aware for the facts.
I didn't choose you, you chose me. When you broke from the crowd and pawed at my knee, soon you'll be feeling right at home. You'll be a bit unsure, but you're free to roam. What's good to chew? What's nice to nibble? Wet food, dry food, tin food, kibble? You might sometimes be cheeky, not always wise, but I know I found love in those puppy dog eyes. Join the free VIP Puppy Club from Pets at Home for advice and exclusive offers, including 10% off your first shop in store. Visit petsathome.com/puppy club or join in store. T's and C's apply.
Back to Squawk Box. Europe joins the rally as the Stock 600 hits its highest level since August 1st, amid expectations of high-level trade talks between the U.S. and China next month. Chipmakers and autos lead gains as trade-sensitive sectors welcome the apparent easing of tensions. And China's Commerce Ministry says the U.S. trade call this morning went very well. Sterling retreats from its biggest one-day gain in more than 5 months as the threat of a UK election still looms despite the government's double defeat in the House of Commons.
48 hours ago, he was leading the chants of stop the coup, let the people vote. Now he's saying stop the election and stop the people from voting.
Hong Kong Chief Executive Carrie Lam says she hopes the withdrawal of a controversial extradition bill will bring stability to the territory.
Don't bubble over with excessive excitement when I give you this information, but we've had the latest decision from the Riksbank, and it's holding its repo rate unchanged at negative 0.25%. There you go. Peter, do you want to comment on that? So the Riksbank says negative 0.25% is the appropriate level of rates for the outlook. The line from the bank says forecasters consider that sentiment has deteriorated, but assume that there will not be any further significant downturns in confidence among households and companies abroad and in Sweden. Do you think that that is the right assumption to make at this point?
Possibly not. And it's interesting they mentioned abroad before they mentioned the domestic market, because it's extremely cyclical and highly export orientated. So they'll do whatever is required as the global economy shows whatever it shows, which at the moment is still a downward path.
It's a bit of a U-turn though, isn't it? I mean, well, it's a bit of a U-turn. When we started out this year, I spoke to the Deputy Central Bank Governor at Riksbank, who sort of put us on notice that there would be more action coming from the Riksbank, so investors should sit up and pay attention. Now we've got a guiding down of most of the rates, the average repo rate for the fourth quarter for Q3. So there's been an adjustment which suggests that, again, things happen, which is saying things happen in the global economy that you can't take into consideration. We've had a whole bunch of things happen on the geopolitical front, haven't we?
Well, the ECB is interesting. So Lagarde came out with agility, as you say, and then there's plenty of members of the ECB saying we're not doing anything. So there is still this assumption that the ECB is going to jump in and do what it takes, but we'll see, shall we? It's not completely convincing yet.
Well, I think we're at a very interesting moment where actually the central bankers are having a moment of reflection about the value of negative interest rate policies at this point. We talked before about the San Francisco Fed study of Japan, arguing that perhaps the imposition of negative rates in itself is disinflationary and has persuaded consumers that deflation is more likely than inflation, and so it has affected spending expectations. And it's interesting here that the Swedish central bank says, however, low interest rates abroad and worsened sentiment mean that interest rates are expected to be increased at a slower pace thereafter than in previous forecasts. So they're talking about how this impacts sentiment is affecting the likelihood of an increase in rates, but they don't say we need to massively cut rates further into negative territory.
What is quite interesting is that 6 savers to every 1 borrower in this country. Let's do the maths again. It's 6 savers to every 1 borrower. So if you make interest rates as low as they can be, what happens? There's no money to spend. There's no money off investments. That was Japan's problem and remains its challenge. If you make interest rates negative, yes, you support the debt bubble, but you do have the other side of it. There are 6 savers to every 1 borrower in one shape or form.
What about the psychology that central banks can save the economy? I mean, we've had Super Mario, for instance, where investors have hung on every word, any change in communication to see whether Super Mario could save the day. But first up, we saw from Powell suggesting that central banks are not all powerful. And then overnight, we've seen from Christine Lagarde saying, I'm not a fairy, I can't just fix markets effectively.
They don't solve. They delay, and all we've done since 2008 is massively increase debt. This time, the Chinese have laid down their economy. That's very kind of them. But that's the reality of the situation. And in 2017, the Japanese debt to GDP was $7 of debt for $1 of growth. The same metric as the US had, no 7. And what's China done since then? Basically gone south for the winter. You reach a certain point, you can't do anything else, and that's where we are today. And we've got negative real rates, barring everywhere except the US, where they're basically flat. We've got real reals are negative, and nothing's happening.
I
it's just incredible.
But are we ready for that reality check, torching expectations that even with a bit of jaw burning, central banks can fix the problem if you torch that confidence?
But there's no credit cycle coming from this. You can do all you like, and bond buying's pointless. You're not going to create a credit cycle, a positive credit cycle, because Japan shows you the footprint. Stop doing it. Go and build some blooming roads and bridges and the other things you've got to do. Stop messing around. Target nominal GDP. Get on with it. Have a market correction, and we can all adjust ourselves, can't we? And buy some cyclicals and other bits which we can move on to shortly. Stop this nonsense of buying bonds, imagining it's going to create a credit cycle. And indeed, the Fed is leading from the front, or one of them at least, by pointing out it's pointless. Right, so what's Trump going to do next? Go to Congress, say, we'll spend $3 trillion. They're going to go, yes, that's okay, knock yourself out. It's sort of almost in the tea leaves. you know where it's going because Lagardère almost admitted it. There's only so much we can do.
Which is why it makes it very difficult to be excessively negative about the outlook for certain parts of the equity market, doesn't it? If we've got public spending that's going to get ramped up.
It's just a bit in the middle. It's possibly getting to the point where you need to have an overwhelming response is not going to be because the S&P is going up 10%.
Let's stay in touch with the markets here. We'll come back to Peter in just a second. We'll talk about some of the other risks out there. But let's have a look at the markets because we are a little bit higher in Europe.
We are, Jeff. Investors this morning, for the most part, chasing the rally. Yesterday marked the fourth positive session in the last 5 for the Stock 600. It ended about 0.9% higher. Now this morning, extending gains up about 0.4% right now. Now, overall, supporting market sentiment are those comments from the Chinese Commerce Ministry overnight saying that Beijing and Washington have agreed to continue their trade negotiations in early October. So that continuing to keep sentiment afloat. But yesterday, of course, Wall Street already off on a strong foot after the news from Hong Kong that Carrie Lam has withdrawn that controversial extradition bill. So providing a good boost there. And then, of course, Brexit developments sharply in focus today, all week here in the UK. It looks like the risk of a no deal come October 31st has diminished. Of course, a huge number of questions remain up in the air. But let's take a look at the different sectors and see what the split looks like this morning. We are seeing a more cyclical tilt to trade. We've got autos, the best performing sector of the lot, up about 1.5%. Technology, industrials, financial services, and construction round out the top performers. So a clear risk on tilt to trade this morning. At the bottom, we've got telecoms, utilities, real estate, and healthcare. So clearly, investors taking money out of those defensive sectors and putting it into the more cyclical, China-exposed parts of the market. Let's dive into the single stocks and see what the individual movers look like. Safran, that is up very strongly, more than 7%. We got an update from the company earlier this morning, and let me just give you the highlights of what we heard from them. They raised their annual forecasts following a strong H1, and they also provided a little bit of an update on the Boeing 737 MAX situation. They said no new information has been given in terms of timing of when we can expect them to return to service, but their base case is that they will return in Q4. So that's their working assumption. Otherwise, would just highlight for you Micro Focus, BHP. They are among those stocks here in the UK who are trading ex-dividend today. So that's, of course, affecting the share prices that you see on the board. But that's the picture in terms of the individual movers. Overall, markets in the green here in Europe. Jeff.
Thanks very much. Let's get to the Brexit update. The British Prime Minister has suffered a double blow in the House of Commons. Backed into a corner, Boris Johnson failed to win support for an election after lawmakers defeated his motion by 298 to 56. Earlier MPs passed a bill designed to stop a no-deal Brexit. In the last few hours, we've learned the legislation will clear the upper house by Friday evening, allaying fears of a marathon filibuster session aimed at derailing the bill. Sterling has firmed on, well, pick any of the various arguments for sterling to firm. Is it because people now believe that there will not be a hard exit from the EU? Let's get out to Willem down at Westminster for more. Is that what is guaranteed now, Willem, by the passage of this legislation?
I mean, if it were to get through the House of Lords over the next 2 days, which we expect it to do, if it were to be given royal assent early next week, which we expect it to be given, then yes, that would be one way of at least guaranteeing in legislation that there will be no deal, as it were, at the end of October. Of course, that doesn't guarantee things beyond that necessarily, but what this legislation also includes are opportunities down the road for Parliament to potentially seize control of the timetable once again if they required secondary legislation like this down the road. So what's important at this stage is the fact that Boris Johnson has seen his efforts to try and apply pressure to the European Union fail. He's seen his efforts last night to call a fresh general election fail. And as you might imagine, he was a little frustrated at his opponent, Jeremy Corbyn, for the situation he finds himself in.
48 hours ago, he was leading the chant of stop the coup, let the people vote. Now he's saying stop the election and stop the people from voting. I think there's only one solution. I think he has become the first, to my knowledge, the first leader of the opposition in the democratic history of our country to refuse the invitation to an election, Mr. Speaker. I can only speculate. I can only speculate as to the reasons behind his hesitation, Mr. Speaker. The obvious conclusion is, I'm afraid, that he does not think he will win.
Watching it last night, it seemed to me that Jeremy Corbyn was aware that he was being goaded into pushing for an election. It's something that he and members of his party have said the last 48 hours they're not willing to do. They won't dance to Boris Johnson's tune, in the words of Keir Starmer, their chief Brexit spokesperson. Jeremy Corbyn said that having an election at a date of Boris Johnson's choosing would be problematic.
The offer of the election today is a bit like the offer of an apple to Snow White and the Wicked Queen, because what he's offering is not an apple or even an election, but the poison of a no deal. So, Mr. Speaker, I repeat what I said last night. Let this bill pass and gain royal assent, then we will back an election so we do not crash out with a no-deal exit from the European Union.
So we could see an election being allowed by the Labour Party, if you will, as soon as early next week. Don't forget, Parliament is suspended as of Monday night under the current circumstances. But when that election will be, there's still some uncertainty. If you listen to different members of the Labour Party leadership about when exactly they would like to see that vote, would it be before October 31st? Would it be after that? They would, of course, wait to see whether Boris Johnson can get any meaningful changes to the withdrawal agreement that 3 times failed to get through the House of Commons behind me at an EU summit in mid-October. And once that happens, once they know what the situation is, they would potentially push in Parliament for an extension, and that would, of course, be very important after that point to figure out when they would like to see national polls once again, guys.
Thank you very much indeed, Willem, for that. Russian President Vladimir Putin is hosting the leaders of India, Japan, Malaysia and Mongolia for a plenary session at the Eastern Economic Forum. We are taking these pictures live. As you can see here, President Putin currently speaking. We will keep an eye on this to see whether anything significant is said at this stage. But as you know, at this set-piece event, we're probably likely to hear a little bit more about the 25 deals that Russia and India are set to sign at this event. Some of them to do with arms, some of them to do with trade, some of them to do with energy, and no doubt, knowing Mr. Putin's track record on such things, there'll be the odd dig or two about the death of liberalism directed at the United States and other Western countries.
Wasn't there? There's a lecture from both Modi and Putin saying there's no role for outside influences in internal matters, which is quite curious when you have two fairly large superpowers talking and teaming up.
Sadly, liberal democracies are relatively new. We all forget that the last 1,000 years is largely authoritarian. Just go through it. Less than 100 years ago, Austro-Hungarian Empire, the Ottoman. I mean, you know, what we have is not, unfortunately, the sad reality of history currently. So Putin can sit there and, sadly, history's on his side. Authoritarian regimes are the dominant factor, if you want to take a long-term view. Not sponsoring them, by the way, just pointing it out.
Now, we just, of course, had the G7 summit where Russia was, front and center in a way in terms of President Trump pushing to have him re-included into the organization. Do you see Russia's relationship with the other G7 leaders improving anytime soon?
Well, Russia's economy is the same size as the United Kingdom, so in theory they're not relevant. In practice, he's just a brilliant politician. So I suspect he's just having his own little fun. It was just an observation that authoritarian regimes are, unfortunately, sadly growing in the world.
Peter, while we just look at these pictures, let me move you on. We've got about 15 minutes or less on the programme. For our audience that are not day traders, who are looking for something slightly longer term in terms of allocating capital at the moment, they look at risks everywhere and they hear the noise and they get confused about what's going to win through. If I wanted to put some money away on a 5-year view or longer,
Can I go longer? Yeah.
Please do. Yeah. What would your recommendation be?
I don't think it changes. The innovation, the world doesn't die because we've created this rather weird world of artificially low bond yields, index chasing, passive investing. Innovation it's generally in the smaller space. It's sometimes in the microcap space and sometimes in the unlisted space. Cheap markets are things like Japan. Japan is cheap. I mean, I know you've been talking about Mike Berry in the last few days. It's interesting. He's identified what we can see ourselves structurally. Net cash, 40% net cash in Japanese corporations. Now, should Japan ever grow? Well, I'll tell you how it's going to work. If my scenario is right and they're just going to go ballistic on fiscal spending and then they're going to write the debt off, which is my personal view, they'll just end up writing it all off globally because they're going to have no choice in the end. Gosh, go long of Japan. Corporates full of cash, individuals have got lots of cash, and they're going to re-liquefy the system because the Japanese are going to make all the bonds 100 years long at 0.1, and overnight Japan's going to reflate. Go long Japan. I mean, I do mean it, and that's the footprint for the future. The way we get out of this hole is, in the end, it's just going to write it all off. They haven't got a choice. I mean, make it 100 years long. The Fed's already muting a 100-year bond, isn't it? Well, guess what? And what happened next? If you make the yields low enough, you just say to everybody who owns them, we'll give you a bit of a high yield and write them off over 100 years. We had war loans in this country once. By the way, the last time the US had this debt level was 1946. What happened after that? What happened to the world? They all had war loans, consort bonds in this country, all sorts of things. That's how it'll go. So yeah, go for the unloved Japan, go for the small mid-cap still, and technology will win. Moore's Law, everything reinvents itself. Buy technology still in the very long term. Of course you do. Why wouldn't you? The innovations, a new energy, of course. I mean, the big new Green Deal that's going to come, of course, is you're just going to decarbonise the world. So just storage, efficient energy, those are the exciting areas. And you just shut your eyes. Stop worrying about the 40% decline that may come. I'm not saying that's the number, by the way. Whatever comes randomly, just forget it, move on, and just buy those on a 10-year view, and you'll be fine. Of course you will.
But can you shut your eyes to the regulation now coming to some of those big tech companies that have had pretty much a free-for-all to grow market cap in recent years?
The big tech funds don't really buy your Apples and Fangs and things. They're already looking at the second and third iterations of that. So that's what I meant about Moore's Law. Where the mutual funds in that space are really exciting and interesting is they keep continuously innovate. They're always looking at the next step 4, 5, 6, and 7. So that's the problem with the FANG index thing. That's how Amazon got to 100 times. Look, I'm not criticising Amazon. I'm sure it's a fantastic company, not at 100 times ratio and a peg of 2.5. Growing at 40%, 100 times earnings. That's nuts. That's crazy, but the tech stocks don't have 8% weightings in Amazon. They have a broad set of stocks, 70 stocks, and they are doing robotics and e-commerce and digital. That's the excitement. It is. My problem is the GEMs, actually, the global emerging markets, because I'm not sure they are innovating. I'm not sure why I would buy Brazil, to be honest, or vast parts of tracts of EMEA, or even chunks of Asia, to be blunt, because they're not the exciting part. Back to the gentleman over here earlier, Matthew, the footprint's global and the companies are exciting. They're global, but they're much lower down and they're tech-related, I suspect.
I'm not sure what the segue is to our next story. How do you feel about sustainable fashion then?
Well, yes, indeed. My daughter is very keen on it. So she's a vegan. I can talk about it at some length.
Well, there you
Believe
go.
it or not, I've had lots of conversations with her about this.
Well, I have a story for you to watch tonight, and this could spark a debate around the living room then. With New York Fashion Week starting tomorrow, sustainability continues to be a big debate within the industry. In the latest episode of the CNBC Conversation, Tanya Breyer caught up with an early campaigner for the cause, Livia Firth, who is the co-founder and creative director of sustainability consultancy EcoAge, and would you believe also the wife of Oscar-winning actor Colin Firth. She asked her about making luxury and fashion brands more sustainable.
Companies come to us for very, very different reasons. Unfortunately, we can never work with the companies that are the biggest enemies, like all the fast fashion companies, because, as a principle, you can't help a company that doesn't believe in sustainability to be sustainable, to greenwash it. And any fast fashion model is based on producing gigantic volumes in very, very short term and moving them very fast because they cost so little. And, the core business model is so unsustainable and it's based on slave labor. If you look at raw material, slave labor and cheap materials. So the environmental and social handprint and footprint is gigantic. So these businesses we can't work with. Now, the businesses that we work with are mainly businesses that really believe in change, and particularly in the luxury space, because luxury companies they have much more funds to invest in research and development, in changing the supply chain to absorb that cost.
How did meeting Colin in Colombia, I believe you were a production assistant, how did that change your life?
Well, it changed my life completely because I was living in Rome and, you know, my life was very different. And then I go to Colombia and I meet Colin. So it changed I had to move country, you know, language and culture.